Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner YouTube edition. Thank you so much for tuning in. And today what we're going to be discussing is going to be about DIY investing. You know, should you go for that option? Is it more expensive? Is it saving more costs for you versus a mutual fund that is there? A mutual fund that is managed by professionals. Sometimes you do have to pay those brokerage fees. But does it make it worth it to do DIY investing? What are the risks that you're taking? What are the do's and don'ts? We have our expert joining in with us for today, Rahul Agarwal of Santushti Capital LLP, to talk to us about that and take us through the do's and don'ts of this. Rahul, thank you so much for joining in with us on the show. It's a pleasure having you on this edition of Mutual Fund Corner. You know, it's very, very important for investors to make the right decision, right? And many investors believe that DIY investing can actually help some bit of a cost, some bit of a saving on that front, given that you would not be paying fees for other mutual fund professionals, which may charge you. But is that a reality? Or, you know, do 90% of these investors actually end up making mistakes because of the lack of expertise? What is your view on this, and what is your advice coming into an investor?
Good morning. Thanks for having me. See, 90% of DIY investors end up losing money and time because usually they make emotional biased decisions which end up in poor timing, they overtrade, and most of it they panic sell. When there's a correction, they sell things that they have been holding for say 2 years or 3 years in panic. Lack of expertise is because they misjudge the risk, the diversification. They fail to understand. In good times, they less diversify their portfolio, and with say over trading, there comes in capital gains, which they short-term capital gains, which they end up paying. And the biggest risk is the missed opportunities that they have. They miss out on long-term opportunities trying to capture short-term gains. So 90%, I say that they lose money and most important, time.
Absolutely, lose money and time, and you miss out on good opportunities that are there for the long term. Just looking at the short-term view, you know, you start trading sooner, you sell stuff. You know, some people have even stopped their SIP, worried about, you know, the situations that are currently going on in the market, which they shouldn't, right? And these are advices that come in from a lot of experts. You know, Rahul, what are the biggest risks when an investor faces while doing a DIY investment, especially on the mutual fund side, versus a professionally managed mutual fund? What is it that is you've seen as a biggest challenge that comes in for these investors?
See, basically, they rely on the research that they do at their own level. Then they try to compare that with the research of a mutual fund, trying to gain returns out of the portfolio higher than the mutual fund, but with the research which is very with a limited research. Most importantly, they don't understand various aspects of the market. Say, for an instance, we are in a down cycle in the interest rates. Now, what happens is we understand that when the interest rate goes in a down cycle, there are mark-to-market gains that have when there is an interest rate cut. But they don't understand that. They see the previous returns, and based on that, they start investing in the funds. So limited knowledge and lack of diversification, and with the limited research they have, they try to outperform the professionally managed mutual fund. That is the biggest risk.
Absolutely, you know, limited research that comes in from an investor. Yes, you should do your own research. It's important, even if you're going for a professionally managed mutual fund. But that limited research for DIY investing is not something that is advisable. And that is why normally people end up going to professionally managed funds or, you know, investing in funds that are there. Rahul, you know, can you just highlight some bit of a thing that is in terms of how do the costs of direct equity investing, whether you have brokerage costs, advisory fees, all of that come in, right? Compare with the expense ratio of a mutual fund. Is there a major difference on that front as well?
Well, see, on the face of it, you can easily say that direct equity investing is much cheaper as compared to a professionally managed mutual fund. But end of it, when you overtrade, you pay more taxes and you end up paying more for the research also. But that also, you don't get that quality of research that is available to a professionally managed mutual funds. So if in totality over the years, if you take it down, then it would be higher than a professionally managed mutual fund.
Okay. And, what about, the funds that are there? Sometimes it's overwhelming, right? There are so many mutual fund options that are there. Even if I'm trying to make my own kind of a portfolio, invest in small cap, mid cap, index fund, then there are different hybrid funds. Top 3 to 5 factors that an investor should consider while selecting some funds. If they are going for that DIY investing type of a portfolio, then how should they be investing, and which are the top 3 factors that they should consider?
The first factor I would say is monitoring the fund's performance in a discrete manner. Usually, what happens is people see 3-year, 5-year returns and miss out that the fund might have performed in a quarter, which has resulted in a 5 years good performance. So need to understand that how the fund has been performing on a, say, quarterly basis or a 6-monthly basis, whatever period you decide. Secondly, you should understand the fund management team and their expertise. Some fund managers are inherently growth fund managers. Some are value fund managers. You need to identify that before going into that fund. And don't go for fancy schemes. If you're going for a DIY investing, don't go for fancy schemes which are all around the corner that have given 100% return in last 1 year. Try to avoid that. And if you can get that data, invest in schemes where there are more advised clients, so that in times of volatility, you will not have emotional redemptions in those schemes.
Okay, surely interesting views coming in there. Important to know the fund managers, and how you should be picking up as well. Fancy schemes, something that you should avoid if you're going in for the DIY kind of an approach. Rahul, there's one thing as well. How should investors decide between actively managed funds and passively managed funds? This is a very big question that always comes in, right, for most of the people, between active and passive. So are active funds still worth it, given that there are higher fees, and especially if you're going the DIY way?
See, firstly, we need to understand that whether it's an active fund or it's a passive fund, it's a fund. The fund is a collection of securities therein. Passive funds have lesser expense because there is nothing to do for a fund manager. You are not going in for the intelligence, the expertise, or the analysis of a fund manager. You're relying on a machine or an algo to decide a portfolio. So that the investor need to decide who he is trying to give the money to. Is he giving the money to a machine to manage, or to a fund manager? Well, I believe that a mix of both is good for a portfolio. Sometimes active funds seems expensive, but in the long term, they prove their worth.
Okay, Rahul, that's really interesting. Active funds may seem expensive, but in the long term, that is something that will surely prove your worth. And, Rahul, just one last word. If someone is doing it, is it better to always go for someone who's professionally managing it? Obviously, I feel that is the case, that you should go for someone who's professionally managing. But would that be your advice as well?
Definitely. See, everywhere it's a season of sports. Even the best batsmen and the bowlers need a coach. So if you go with somebody's expert advice, you are more likely to achieve your goals in a long term more surely, rather than doing it yourself. And see, the currency that you are investing today is not the money. You should understand the biggest currency you are investing is your time. The compounding, if you waste 2 years or 5 years today, you will lose out on compounding on those years, which are very beneficial if in a longer term.
Absolutely. And I think I loved it that what you said, the currency you're investing is your time. To get that benefit, obviously compounding is a factor that plays out. But Rahul, thank you so much for joining with us on this special edition of Mutual Fund Corner. It's a pleasure having you on the show and understanding the DIY investing, what are the do's and don'ts, and how one should compare themselves with professionally managed mutual funds.
Thank you.
Thank you.
Bandhan Mutual Fund presents MF Corner.